Welcome back to another episode of Intended Consequences, the official podcast of the StrategyCorp Institute of Public Policy and Economy. I'm your host, Sebastian Lebrec. If I were to ask you what do Norway, the UAE, Saudi Arabia, and Kuwait have in common, your first answer would probably be oil, right? But what if I add Australia, China, and Singapore to this list? Well, these jurisdictions share one characteristic. They all have sovereign wealth funds. Truth be told, North American policymakers probably don't think about sovereign wealth funds all that often, but there are good reasons to talk about them today on the show. As interest rates rise, countries are increasingly worried about their debt. For commodity-producing states, the impact of the energy transition on their revenues is very much top of mind. But how can jurisdictions navigate these challenging circumstances to ensure the long-term financial prosperity of their economies? For some countries, part of the answer very might be sovereign wealth funds. My StrategyCorp colleague Elena Mantagaris actually recently co-authored an op-ed in which she argued that Canada needs a sovereign wealth fund, so I invited her to discuss this interesting topic. Joining her is the co-author of the op-ed, Matthew Bianco, a former managing director and head of capital markets risk optimization at Canada Pension Plan Investment, or CPP Investments for short. Thank you so much for being here. All right, so let's get started. Elena, I'd like to set the stage a little bit. The term fund seems to mean different things in different contexts. There are sovereign wealth funds, pension funds, hedge funds, innovation funds, green funds, and I could keep going. Can you tell us what a sovereign wealth fund is and what it's not?
That's a great question, Sebastien. Simply put, a sovereign wealth fund is essentially a state-owned investment fund. And very often, the monies that are invested typically come from surplus government revenues, or they're derived from things like royalties from natural resources. And, when we look at those different funds that you've just mentioned, right? So if we think about pension funds, these are typically financed by employers and employee contributions. So the returns on those funds are distributed back to individuals who actually paid into the pension fund. Something like a national growth fund is usually created with a targeted investment mandate that's really aligned to government priorities and is focused on trying to grow specific industries in the country. So, for example, Canada now has a Canada Growth Fund, and it's focused on investments in clean tech that'll help transition and decarbonize Canada's economy. A growth fund will, typically provide funding in the form of loans or equity investments to help catalyze or scale up a sector. In contrast, a sovereign wealth fund can be financed by potentially multiple government revenue sources, and a percentage of those returns from those investments are then deployed back into social programs and priorities. So, just to sort of summarize it, returns from something like a pension fund benefit individuals, a national growth fund targets industrial development of a country, while returns of a sovereign wealth fund actually benefit the broader society by helping to finance our social programs.
That's a great description. It can be a very daunting topic, but I think you set the stage very nicely here. As I mentioned, there are several countries that have sovereign wealth funds. What are the main drivers that lead to jurisdictions establishing these funds? In other words, why do countries have them? Elena, we'll stay with you.
Yeah, so sovereign wealth funds are often framed as funds for future generations. The goal is ultimately to save money to benefit future generations and enable what we often refer to as intergenerational equity. The reason we do that is we're really ultimately recognizing that the resources that we're using today and receiving today, particularly from things like finite natural resources like critical minerals or oil and gas, should also benefit our society tomorrow. And as I've already mentioned, often a percentage of the returns from sovereign wealth funds are used to fund a portion of a country's public social programs. That's why they're actually sometimes also referred to as social wealth funds.
Matt, any other thoughts?
Yes. Well, I think the first thing that the decision makers involved in setting up a wealth fund would need to consider is whether or not a wealth fund is the best use of the funds that are coming from these royalty streams or other sources of revenue. And the first option that they consider is simply retiring existing debt. This is kind of a no risk option that they can consider. And in a way, it also generates a revenue stream for the future by eliminating future interest payments that the jurisdiction would otherwise be required to make. However, I think there are a lot of good reasons why an investment fund could be the better path for many locations. And in Canada in particular, natural resources, including energy, are a large part of the economy in many regions. Commodity markets are highly cyclical. They experience long periods of booms and busts. These periods translate directly into higher or lower royalty streams, social program spending, corporate tax payments, and individual tax collections. For a jurisdiction that depends heavily on highly variable sources of revenue, these boom and bust periods can put great stress on their finances. And if it's structured correctly, a wealth fund can be used to transform a highly volatile, concentrated portfolio of revenue sources, like these commodity revenue streams, into a pool of assets that can be used to countercyclically balance those streams. And I believe that's the real value proposition for a wealth fund in this case, rather than trying to promise that these funds will generate outsized investment gains, which is unlikely and it includes a great deal of risk. I think what you can reasonably promise is that they can be used to smooth out these fluctuations over time. The other potential advantage that a fund can provide is that if it's managed properly, it can diversify a certain area away from the natural risk concentrations that they have. So if an area is heavily dependent on oil revenue or mining revenue, they can take that, use it to buy a portfolio of financial assets or businesses from other industries and other regions, and overall their financial profile will then be more stable, and it will be more insulated from any secular changes in these markets. So this has other ancillary benefits. It can sometimes result in improved credit ratings for the jurisdiction, lower interest costs, and this type of diversification is often called, in the investment business, it's called the only free lunch in finance, because you're effectively, without any cost, reducing your risk exposure. And I think that should be an explicit goal of any wealth fund.
Sovereign wealth funds are about future generations, but politicians tend to focus on the short term because they want to get reelected. So I can totally imagine that there's a risk for sovereign wealth funds to be politicized and used as slush funds. In this regard, how can this situation be avoided, and what are some of the key principles that guide the establishment of a wealth fund? Matt?
Well, we've definitely seen a lot of examples of sovereign wealth funds and public pension funds that have been utilized for purposes other than benefiting their constituents. And in particular, there are two channels where politics can dilute the core mission of a sovereign wealth fund, which should always be focused on the maximization of returns for its beneficiaries. So the first of these is imposing politically driven criteria for investment selection, or similarly by forcing portfolio companies, the companies that the wealth fund invests in, to pursue political aims. And we've seen this being a big factor over the last several years with regard to environmental, social, and governance criteria. The other area that we've seen sovereign wealth funds being misused is related to channeling funds to local, often politically connected firms or individuals. There are certain best practices that the funds can implement that should help reduce or minimize these issues. So as an example, the first major factor would be to insulate the fund managers from political interference. The board of directors should be selected from the private sector, people with investment expertise rather than being political operatives. The criteria for evaluating the fund performance should be really focused on evaluating its long-term risk-adjusted returns that it's generated, without adding additional political constraints. And the other key item is to have staff compensation, the investment managers themselves. That compensation should be aligned with the long-term fund performance, which means that the interests of the managers and the staff are highly aligned with the interests of the beneficiaries. I would also say that another key aspect is transparency. when a private investment firm has a partnership with a sovereign wealth fund, it can be worth many millions of dollars per year in fees. The plan should be required to publicly disclose all these partnerships, and this might be a bit controversial, but there also needs to be transparency in terms of the fees and the terms that the organization agrees to, how much they're paying each manager, and under what formula that compensation is calculated. And then the last area I would mention is that these funds should not really be used to, they should not be required to invest a certain percentage in local companies. This is an area that often results in abuse, or at the very least results in a suboptimal investment process. The local firms that receive these investment funds often are the ones with the best political connections. And instead, the investments should all be evaluated on their own merits, and any investments into local funds should be decided directly through a political process and should not be imposed on the wealth fund.
So the op-ed you published together argued that Canada needs to seriously consider the sovereign wealth fund model. My question here is twofold. First, why do you think Canada needs a sovereign wealth fund? And second, how should Canada go about setting one up? Elena, we'll start with you.
Well, I think, we need to refer back to what Matt said earlier, which is you're really trying to smooth out boom and bust cycles of your economy. But even looking beyond that, I think it's no secret that right now we're dealing with a lot of global economic changes and geopolitical turbulence in our world. So that means there's a lot of uncertainty for Canada as it tries to find its foothold in this sea change that we're living through. So we need to think about how we create buffers and resilience in our country to ensure that our societal values, our social programs like healthcare and public housing remain intact to support people today and tomorrow. And a sovereign wealth fund actually helps us do that. When we look at our ecosystem of funds, Canada was essentially a leader in recognizing the importance of ensuring that our seniors, after a lifetime of working and contributing to our society, should have some basic pension security in the latter part of their life. And something like the Canada Growth Fund is a recognition that the shift to create a decarbonized economy requires a concerted focus to effectively scale up strong and resilient industries. Now we need to turn our attention to how we fund our social programs for the long term, looking beyond our immediate income taxes by actually saving money today to invest for tomorrow. And I really think Canadians understand this basic principle in their own individual lives. And now we need to translate that principle into how we think about managing government resources and revenues.
And in terms of the logistics of setting up such a structure, what we're proposing is an independent investment management organization with the capability to manage capital on behalf of multiple participants or jurisdictions. The revenue streams would be the sources of funds that belong to these individual provinces and localities. And rather than a single monolithic fund, we would propose a cooperative approach to managing separate pools of capital. So the benefit of this is that the capital would be managed by a professional investment team. It would have all the resources that it needs to be effective, but all the costs of personnel, technology, data, and such would be shared, keeping the costs reasonable, and each of the participants would be able to benefit from those economies of scale. But importantly, I think the ownership of each pool would remain with its contributor. So that would ensure that, for example, those funds are not diverted from one jurisdiction to another to, let's say, cover shortfalls in that other jurisdiction's investment portfolio. And I think another advantage of this cooperative approach is that the combined pools of capital would also be large enough to be considered an attractive investment partner, and they would be able to participate in large, complex transactions, and they would have the weight to negotiate good terms and low fees in their investment process.
Obviously, Canada has a federal model, and there are already, large pension funds in some provinces like OMERS and La Caisse de dépôt et placement. I'd be curious to ask you, Matt, the cooperative approach that you're proposing, is that in response to federalism in a way?
I think it is. I think it follows in that spirit. As we mentioned, the idea would be to cooperate on the management of the portfolio, but to keep the pools of capital separate. This would allow each participant to design their own investment objectives and guidelines. They would decide the types of investments that would be ideal for them, how much risk that they are comfortable taking. And they would also then have the flexibility to decide how to draw down from their pool, how to utilize the capital over time, and for what reasons and under what conditions it can be taken out. And as I mentioned earlier, importantly, the funds cannot be commingled in any way. There needs to be a firewall between the different portfolios. I think the other area of protection that we would propose for the participants is that at the end of the day, if for any reason a particular participant becomes dissatisfied with the services that they're receiving, they would have the option to take their money out of the program and find an alternative manager, whether public or private. I think that really leaves them with the ultimate control of their assets. And I think that might help funds that might help localities to get comfortable with participating, knowing that they always have the option to go down a different path if that becomes necessary. And I think also a more monolithic program would not be as attractive because of that fear of losing control over a particular jurisdiction's financial assets.
I'm just thinking, Matt's comment about sort of leveraging expertise and the backbone. I think right now of the Canada Growth Fund that was established, and the decision not to recreate an entirely new structure, but rather leverage the expertise and knowledge of PSP Investments, right? Scaling it and focusing it in a completely different area and with different types of investments. There's only so much expertise to go around. Let's use that expertise and federalism as a structure to our advantage when we're setting up a fund like this.
I'd be curious, both of you kind of mentioned already this idea, it would be professional investment managers that would take care of it. Who would those people be? Which organization are you thinking of?
I think our initial thought is that a new dedicated organization could be created to manage these funds, and it would be the organization itself would be managed cooperatively by the different participants, similarly to sort of cooperative models that we see, for example, with utilities and things of that nature. I think that there's always the option to outsource it to a private firm, but that does raise its own set of different sorts of challenges and questions about the costs involved as well.
And I think maybe just to give another example, building on Matt's comments. I mean, the case, for example, right, is an amalgamation of different funds that are now being managed under one sort of entity. And I think it's a great example of how that kind of cooperative approach really works, drives that administrative efficiencies, taps into expertise that smaller funds wouldn't necessarily be able to access if they were on their own. So yes, a new entity, but certainly a backbone across the different contributors.
We mentioned there are a lot of jurisdictions with sovereign wealth funds. So if Canada were to go forward with establishing one, what are some international examples that Canada should pay attention to, both in terms of what to do and perhaps what not to do? Matt, we'll start with you.
Sure. I think when people talk about this area, when discussing the best pension funds or best sovereign wealth funds, the general consensus is that the Nordic countries represent the gold standard in this area. Norway's government pension fund is arguably one of the largest investors in the world, and they have a long-term track record as a high-quality investor, producing good investment returns for their participants. I would say the other major international fund that people often cite as being an example to follow is Singapore's GIC fund. They're highly regarded and they're considered a thought leader in terms of investment strategy and also being considered a good partner. And then, closer to home, I would also point to the Canada Pension Plan as being a model. I think in particular, we can look back to the highly political environment in which it was created and the fact that it was set up to be fairly arm's length away from the political process, and how it was really focused on beneficiaries first and producing good performance for them. And I think they have a lot of best practices implemented there as well that we can look to try to minimize political interference. I think all of those organizations have a long track record of producing steady, if not spectacular, investment returns, of managing the risk of these investments prudently, and I think also operating with high integrity, which I think is important in a public fund like this. In terms of organizations that I would say we would want to use as cautionary tales, and which have had poor results over time, I would point to a lot of the local and state pension plans within the United States. Many of them have a really dismal track record of poor investment performance, paying very high fees, above market rate fees, putting political considerations ahead of investment performance. There have been a lot of high-profile cases of corruption and kickbacks, poor governance, making investments that they don't really understand, and taking excessive risks. So I think we need to keep those clearly in mind as well, and ensure that anything that we do is insulated from those types of pitfalls.
Elena, what do you think is the number one lesson for Canada as it undertakes potentially a sovereign wealth fund?
Well, that's, rather than a lesson, I would actually like to point to another positive example, because I think that, Matt's pointed out diversity of funding examples or sovereign wealth fund examples. And one of the things I find interesting about each of them is that they also have a diversity of funding sources, right? So we know something like royalties from natural resources are frequently a significant source of funds, but I actually think we can be more creative than that. And I'm looking to Quebec right now because Quebec has actually established a generations fund. It's actually something that's fairly under the radar. But what they've done is they've used some of the revenues from Hydro-Quebec as a funding source. They've also used revenues from the alcohol tax as well. And they have already accumulated in a few short years over about $20 billion in their generations fund. And they've committed to $4 to $5 billion per year in contributions, expecting the fund will be about $37 billion by 2027. They plan to use those revenues to actually pay off their provincial debt. And at the rate that this fund's growing at and the contributions they're making, I think the fund itself is going to be close to provincial sort of debt levels within our own lifetime. And that's an incredibly powerful position for Quebec to be in. So imagine you're able to eliminate your provincial debt, invest in your social programs, sustain your society according to its values and priorities. And I think that's actually the kind of forward-looking agenda and planning we want from governments, to essentially protect our interests and invest in our society. And when I think of, Ontario, imagine if Ontario were to replicate this concept using the $1 billion a year that they get from alcohol sales, or let's throw in cannabis sales, and even adding the natural resource royalties from critical minerals that we're so eager to extract right now for electric vehicle batteries. If we had this in place, we'd be having a very different discussion about how to pay for our social programs, as we increasingly have fewer workers for every retired person. So I think this is the kind of thing that could be a game changer in our society if we really thoughtfully planned this out.
And I think that's a great way to end. It's a complicated topic, but I must admit the two of you did an absolutely phenomenal job today explaining what a sovereign wealth fund is and why Canada should have one. So if you haven't read the op-ed Elena and Matthew wrote, make sure to check it out on the Globe and Mail website. It's titled, "Canada Needs a Sovereign Wealth Fund for the Sake of Future Generations." Thank you for listening to Intended Consequences.